Welcome to the School Pre-Retirement video. We have created this video in response to the cancellation of our School Pre-Retirement Seminars and the cancellation of our office visits here at NPERS. This video is designed to provide assistance and information for members who are planning on retiring this year. We want to clarify members do not need to attend a seminar or have an office visit to retire. NPERS has taken steps to continue our daily operations during this outbreak. Several of our staff have been set up to process benefits from home. While we have no idea what the future holds, we will continue to make every effort to serve our members. We have quite a few topics that we're going to cover today in the video. We're going to talk about the plan design, how benefits are calculated and determined, the options that members will have at retirement when filling out their paperwork. We'll show you how to use our benefit estimator. We'll talk about reemployment and the application process and the timeline. Before we get into that though, let's talk first about our contact information. This is the office that you'll need to get a hold of when you're ready to apply for your retirement. We have our physical address there, our mailing address, and our phone numbers, fax numbers, and website address. Our website has quite a bit of information on it for our plan members to assist you with your retirement. One thing I'd like to point out, under the publications page on our website, you can find the School Plan Handbook. This is going to be a very good resource for you, along with this video, to learn more about how your plan functions. And also the website has the benefit estimator on it, which we will again talk about later on during this video. Another feature of the website is the online account access. If you create an online account prior to retirement, you can review the salary and service history that your school has reported to our office. You can also see the individuals that you have currently designated as beneficiaries prior to retirement. Once you retire and begin receiving your benefit, then the website offers up some additional functionality. You can change the amount of taxes that you're having withheld from your retirement, and you can also get your year-end tax statement if you have created an online account. Now let's move on and start talking about the design of the plan. The type of plan that you have as Nebraska Public School employees is called a defined benefit plan. And when you have a defined benefit plan, your retirement benefit is a lifetime monthly pension check. Your account balance is not important in determining the amount of that pension check. Instead, we look at a formula to calculate the monthly amount. This formula is determined on these factors, and the two biggest factors are your salary and your years of service. We're going to go through all of these and talk about how they affect the benefit calculation. Now, the unicameral has made changes to the school retirement plans over the years, and this has created different tiers of benefits. But as we go through the presentation today, we will talk about how these have changed over time so that you can determine which benefit tier you fall under and what your specific benefits are. The first formula component we're going to talk about is salary. And if you fall under the original tier of benefits, we're going to look at your three highest 12-month periods to determine your benefit. And when we look at their 12-month periods, the way we calculate this is we look at your final payroll date, and then we count back 12 months from that moment. That creates your first 12-month period. Then we continue to count back through your entire work history to create all of the 12-month periods. Then we pick the three highest if you fall under Tier 1. If you fall under Tier 2, 3, or 4, we'll use your 5 highest. And these do not have to be the last years that you worked. They don't have to be consecutive. We're going to go through your entire work history to pick the highest, and then we're going to average those to create your average final salary and compensation. The next step is to look at how many years of service you have accrued in the plan. Creditable service is granted for time worked and contributions made during that time. Under the current law, 1,000 hours of work creates 1 year of service credit. Now, the rules have changed in regards to service credit over the years. You can refer to the plan handbook for more information on that, but we're going to talk about the 1,000 hours. So once you have worked 1,000 hours, you have reached the maximum amount of service credit you can receive for that year. What if you only work part-time? Let's say from July 1st through the end of June you only had 500 hours. If you're participating in the plan and contributing, then you would get partial service credit, and 500 would give you 1/2 a year of service credit. So we calculate all the service credit you've accrued over your lifetime and use that when we calculate the amount of your benefit. One way that you can track how much service credit and the salary we're going to use is by looking at the statements that we send you every year. Each year the statement will indicate what your school has reported to us as your salary compensation for that last fiscal year. Their statement also will then include the total years of service we have on file. So we encourage you when you get these statements to review them for accuracy and then save them as a document that you can utilize to see what we will be using when we calculate your benefit. Let's discuss now benefit eligibility. There are specific things that have to happen in order for you to begin receiving that lifetime monthly benefit. The first one is you have to terminate employment at all participating employers. The next three we're going to break out and talk about. You need to be vested in the plan, you need to attain retirement age, and then you have to establish an effective date, which basically means submit your application for retirement. Let's begin with eligibility and vesting. Most individuals will vest themselves by accruing 5 or more years of service credit in the plan. If you are not vested, if you don't have enough service credit, then you're only eligible for a refund. And a refund will not include the employer's match. There is a provision in the law that does allow for vesting if you work for a participating employer on or after age 65. If you have 1/2 a year of service credit at that time, you will be vested in the plan. This law, however, was changed so it does not apply to school plan members who were hired and began participating in the plan on or after July 1st of 2016. Once you are vested in the plan, then you're eligible to receive that lifetime monthly pension once you reach retirement age. When we talk about retirement age, we're looking at your age on your effective date of retirement. In other words, we don't look at when you quit working. We look at what age you have attained when you begin drawing your benefit. And your age will determine whether you're eligible for a full unreduced benefit, or if you started early, there may be a benefit reduction. Let's begin by talking about the unreduced benefit. In your plan, normal retirement age is age 65. So once you attain age 65, if you've terminated employment and you're vested, you can begin drawing an unreduced lifetime benefit. Your plan also has a provision called the Rule of 85. Under tiers 1, 2, and 3, the Rule of 85 says that once you attain the minimum age of 55, then from that point on, if your age plus your total years of service credit equal 85 or greater, you can cease employment and begin drawing an unreduced retirement benefit at that age. But what if you're never going to attain the Rule of 85? Let's say you're age 60 and you only have 10 years of service credit, but you've decided that you want to cease employment. You're not going to meet the Rule of 85, you don't have enough years of service, and you haven't attained age 65. But you can begin early reduced benefits from ages 60 to 64 if you're vested in the plan and have terminated employment. There is a benefit reduction, and that reduction is 3% for every year that you are under age 65. So in our example, if that individual terminated employment at age 60 with 10 years of service credit, they would have a permanent 15% reduction in their lifetime benefit. Now let's look at the effective date, or when should you apply for the benefit. This is the final step of eligibility. An effective date is when your benefits begin, and you do have to submit your completed retirement application to establish an effective date. Your effective date will be the first of the month following when all three of these things have occurred. Number one, you're eligible for benefits. And you refer back to what we just talked about, that means you are vested in the plan and you've reached the age requirements. And you've terminated employment and your completed retirement application is received in our office. So again, all three of these things have to occur, and then the first of the month following will be your effective date of retirement. You can usually see your first payment anywhere from 60 to 90 days following your effective date of retirement. That first payment, however, will be retroactive to your effective date. So if you receive your first check 90 days after your effective date of retirement, the first check would be for 3 months. Some of our school plan members may see a preliminary benefit. This is not unusual, so if you see on your paperwork that you're going to receive a preliminary benefit, there's no need to worry or panic about that. What we're doing in this situation is we haven't received the final compensation and service credit information from your employer yet, but we want to try and begin processing a benefit to get money to you. So what we'll do is, if we don't have all the data that we need, we process a preliminary benefit and begin paying that to you. Then once the school has finally provided us with all the information that we need, we'll go ahead and recalculate your benefit to get you fully up to speed. Let's talk now about the benefit payment options. When you receive your retirement packet and you're reviewing your application for retirement, you'll notice on there that you will have to pick a benefit payment option. Picking the option is very important because it will determine the potential for a death benefit to be paid when you pass away during retirement. It also will have some determination on how much money you will receive in that monthly amount. I'd like to point to the handbook that is, again, available online. The handbook, beginning on page 21, does list all these benefit payment options, but we'll talk about them briefly right now. The first option is the life only. Now, I got ahead of myself there. Under all of these benefit payment options, you will receive a lifetime benefit, regardless of which one you pick. As we go through these, focus on the death benefits. Now let's come back to the life only. The life only is probably the easiest of all the options to explain because there is no death benefit payment. So an individual who picks this option at retirement will receive the monthly lifetime benefit. But when they pass away, there is no death benefit that is paid out. Let's move to the next one, the modified cash refund. Now, under the life only option, it is possible for an individual who picks this option to not get back the money that they even contributed into the plan. The modified cash refund is designed to address this concern because the modified cash refund provides the lifetime benefit, but it says if you pass away before you have received your account balance, then the remainder is paid as the death benefit. To give you an example, let's say at retirement you had a $60,000 account balance. And when we look at account balance, we're only looking at the money that you have contributed to the plan. We don't look at what the school has contributed. If you had a $60,000 account balance at retirement, and if you select the modified cash refund, if you draw, say, $50,000 before you pass away, the death benefit would be $10,000 paid to your beneficiary. But if you draw more than $60,000, let's say at the time of your death you had drawn $70,000 or $80,000 or more, then there would be no death benefit paid. The next option is called the period certain and continuous. This one provides a death benefit potentially paid out based on a time frame. And there are 3 sub-choices here, a 5, 10, or 15-year option. Well, let's talk about the 5-year option, and the others work the same way, just longer time frames. Under the 5-year option, again, this is a lifetime pension benefit for you, the plan member. The 5-year option provides a guaranteed payment for your beneficiaries for the first 5 years you draw your benefit. And 5 years is 60 months. So if you pick the 5-year option and you drew your benefit for, let's say, 4 years or 48 months and then you pass away, that means there would be 1 year left under the 5-year option and your beneficiaries would receive a benefit for the final 12 months. But if you pick the 5-year option and you draw your benefit for more than 5 years, then when you pass away there is no death benefit. You could, however, pick the 10 or the 15-year option, and that increases the potential for a death benefit payout. Which brings me to something I want to point out. The life only is the highest paying of all the options because it has no death benefit potential. the higher the potential the plan is going to have to pay out a death benefit, then the amount of the monthly pension is actuarially reduced to offset that potential death benefit. So when you look at the 5, the 10, and the 15-year options, the 15-year option has the highest potential for a death benefit payout, but it does provide the lowest monthly pension amount for you, the plan member. Now, under the modified cash refund and the period certain and continuous, these options are the only two that provide plan members with beneficiary flexibility. And beneficiary flexibility generally means one of three things that you may or may not want to have for your retirement. The first one is that you want to list more than one individual as a beneficiary. Let's say you want to put down 3 or 4 or 5 people as a beneficiary. That's number one for beneficiary flexibility. The second is perhaps it's not an individual that you want to list as a beneficiary, but it's maybe a church or a charity that you'd like to put down. That's number 2 for beneficiary flexibility. And then the final is you want to be able to change your beneficiaries after you've begun drawing your retirement benefit. If you want to be able to do any of those 3 things, then the only options that provide that beneficiary flexibility are, again, the modified cash refund and the period certain and continuous. Let's go to the next one now, the joint and survivor. This option does not provide beneficiary flexibility. Under this option, you are designating your spouse as your beneficiary, and you technically do not get to pick who your beneficiary is under this option. Your beneficiary automatically becomes the individual that you are married to at the start of your retirement, and you cannot add or change that beneficiary during your retirement. And the way this benefit works then is you're guaranteeing a lifetime benefit not only for you, but also for your spouse. When you pass away during your retirement, if your spouse is still alive, the benefit that you are receiving transfers to them at either 50, 75%, or the full 100% of what you are receiving at retirement. When you fill out your application, you'll have to pick which one of those 3 options you'd like to choose. There are some pluses and some negatives with the joint survivor option. Obviously, a plus is that you're creating a guaranteed lifetime stream of income, not only for you, but also for your spouse. The negative or the downside of that perhaps would be that you cannot pick another beneficiary. So if your spouse predeceases you, you cannot add another beneficiary. You'll still get that benefit for the rest of your life, but when you pass away, there is no death benefit. And then the last option is called the non-spousal joint and survivor. This is very similar to the 50% spousal option. The main difference is you get to designate whoever you want as your beneficiary. But under this option, you can only designate one human being as your beneficiary, and that single individual becomes your only beneficiary. You cannot change or add another person. Then when you pass away under this option, if that individual that you've designated as your beneficiary is still alive, your benefit transfers to them at 50% of what you were receiving when you passed away, and they will receive it for the rest of their life. Under both the joint survivor and the non-spousal joint survivor option, you need to be aware that we will be looking at the age of your beneficiary to calculate the amount of your monthly benefit. So if you select an individual who is significantly younger than you as your beneficiary, because we have to pay that individual for their lifetime when you pass away, this will reduce the amount of your lifetime monthly benefit. We ran our benefit estimator that we have online 3 times to create this next slide. I think this is a really handy slide because it kind of shows some of the things that we've talked about previously in the video. When we ran our benefit estimator these 3 times, we always used the same salary of $35,000 a year. So that hasn't changed as we look through this chart. But we did make some changes as we went through it to demonstrate how your plan works and how the benefits are calculated. Let's look at the first column. This individual began their retirement at age 65. So again, that's considered normal retirement age, so there is no benefit reduction. This individual, we calculated their benefit on, again, the $35,000 a year salary and a 20-year total service credit accrual. So when you look up and down the first column there, you can see the life only is the highest paying because it has no death benefit. If you look at the period certain and continuous, you can see as you increase the death benefit time frame, the benefit amount correspondingly is actuarially reduced. Let's go to the middle column. For this individual, we kept the salary and the service the same. So still at 20 years of service, still a $35,000 salary. But this individual, we're going to have them start their benefit hypothetically at age 60. Now at age 60, with 20 years of service, they do not meet the rule of 85. They can, however, apply for and begin their benefit if they have terminated employment. They will have a benefit reduction, however, and their benefit reduction in this example, because they're starting their benefit 5 years before the age of 65, at 3% for every year, that means this individual is looking at that 15% total benefit reduction. They do have some choices here. I mean, they could wait. Every year they're 1 year closer to age 65, that benefit reduction decreases. And they could wait all the way until they reach age 65 and then apply. And then they would receive the full benefit, the same amount the person in the first column is receiving. But one thing to point out is that if you quit at age 60 and wait until you're 65 to get the full unreduced benefit, you are avoiding that permanent reduction, but you are also missing out on drawing the benefit for those 5 years. Whether or not that is a good or bad choice is hard to say. It really depends on each individual. And then the last column, we'd like to give you an example of meeting the rule of 85. So we kept the salary still at $35,000, but we gave this individual 10 more years of service credit. So with 30 years of service credit, this individual can terminate their employment and begin their benefit at age 55. So when you look at that individual, they're getting an unreduced benefit. That's nice. They're also drawing it earlier than age 65, which is also nice. But you notice they're receiving even more money than the individual in the first column. Now both of these are unreduced full benefits. The rule of 85 isn't really increasing their benefit at this point. It's just allowing them to draw that unreduced benefit earlier. What's increasing the amount of that benefit is the 10 more years of service credit. If you give the person in the first column at age 65 30 years of service, they would essentially be receiving exactly the same benefit. We do encourage people to go out and use the benefit estimator that we have on our website, and let's talk a little bit now about how to utilize this tool. This is the first screen of the estimator where you will enter your data. I'd like to point out that the estimator resides on the non-secure section of our website, and that means you do not have to create a login to utilize this tool. Anybody can go out there and take advantage of it. As we look at the first screen there, you notice the first field you have to input your date of birth. Your date of birth is the only personal identifying bit of data we are going to ask you. We are not going to ask you for your name. We're not going to ask you for your social security number because we want you to be anonymous when you're using the estimator. We do have to ask you for your date of birth, however, because we have to know if you're old enough to begin drawing the benefit. The next screen or field is going to ask you for your estimated date of termination. Again, you have to cease employment at all participating schools in the plan to begin drawing your benefit. And then the next field underneath that says, well, okay, now once you have quit, what is your effective date of retirement? When do you want your benefits to start? Now, all of those date-related fields, if you click on the calendar beside them, you'll see that there are drop-down fields that you can use to pick the proper date. The next field underneath that is going to ask you for how many years of service do you have once you've terminated employment. For our hypothetical example here, we're going to use 20 years for the years of service. The next field under that is going to ask for salary information, and when did you begin plan participation. Plan participation is to help us determine which tier of benefits that you fall under. So when you click on the drop down, if you fall under tier number 1, you would mark that you began plan participation prior to July 1st, 2013. The salary fields have a help box that you can click on to get more information about what you need to plug in for salary. If you do fall under the first tier of benefits, you have to input your 3 highest years of salary. If you fall into the later tiers, you'll have to put in your 5 highest years of salary. The next field underneath that asks for your account balance. Now we've broken this up into 2 separate screens here. Account balance actually is not that important, and you can leave this field blank if you wish, and the benefit estimator will still work for you. If you'd like to, however, plug in your account balance, you can grab the last statement we sent you that will have your account balance on it. Let's look at the next field, beneficiary type. Now we talked earlier about the joint and survivor and the non-spousal joint and survivor. This is where you tell the estimator if you're interested in either of those 2 options and you would like to see a dollar amount under either of those 2. So for our example here, let's say our person using the estimator is married, so they would like to see a dollar amount under the spousal or the joint and survivor option. So from the drop down, they'll pick spousal. That's the same thing as joint and survivor. Once you pick that from the drop down, then it's going to open up another field, and that is the lower screen print that you see there. We need to know the age of your beneficiary, whether you pick either the spousal or the non-spousal option. So when you pick that, you'll have to then plug in the age of your beneficiary. And then the last field asks you, would you like to calculate taxes? We're going to leave this at no for our example here. If you do elect to pick yes and calculate your taxes, one thing I want to point out is the estimator is not going to be able to know if you've got other deductions that would be reducing your taxes. It's also not going to know if you have other income that could be increasing your taxes. So you need to be cautious about using that tax calculator on our website. Then when you click on Calculate My Estimate, it'll take you to the final screen of the estimator, which then shows you the different options that we just talked about, and then the monthly dollar amount that you would be eligible for under each of these options based on the criteria that you plugged into the estimator. And you may notice that you're in charge of plugging in whatever you want into the estimator. We did this on purpose to give you the ability that if you still are a few years away from retirement, you can plug in a future retirement date. You can guess how many years of service you think you'll have at that time. You can guess what you think your salary will be at that time, and still get some idea of what your benefit might be 3 or 4 or 5 years down the road. Let's talk now about the COLA, the cost of living adjustment that is offered in your plan. This is an annual adjustment that occurs each July, so it's automatically handled by the retirement office. You do not have to apply for it. This is a benefit increase that is based upon the annual change in the Consumer Price Index. In other words, inflation. Now, Tier 1 and Tiers 2, 3, and 4 have different COLA provisions. Under Tier 1, the maximum increase that you'd be eligible for is 2.5%. So let's say inflation is calculated at 1% using the CPIW. That means that you'd be eligible for a 1% increase in your July check. But let's say inflation was higher that year. Let's say inflation was 5%. In that scenario, Tier 1 members would get the maximum of 2.5% for their increase. Now in that example, they have, in theory, lost a 2.5% purchasing power, and that is tracked. If at any time their loss of their purchasing power reaches 25% or more, the statute says you have to maintain at least 75% of the original purchasing power. So once that moment happens, that individual would get the full CPI increase, or in the example we just gave you, if the CPI was 5%, they would receive a 5% increase in your benefit. That is how Tier 1 is handled. Tiers 2, 3, and 4, the maximum cost of living increase is reduced to 1% from the 2.5%, and there is no 75% purchasing power provision with Tiers 2, 3, and 4. Let's talk now about taxes. The money that you contribute to the retirement plan and the money your employer puts in are pre-tax, which means you have not paid state or federal income tax on those contributions. That means when you begin taking money out of your retirement, it is considered taxable income. How are these taxes withheld? Well, this is basically the same way you're having your taxes withheld right now from your earnings. When you begin working for an employer, you fill out a W-4, which tells them how much do I want withheld from my paycheck. And then at the end of the year, your employer sends you a W-2, which you use to calculate the amount of taxes that you're either going to have to pay in, or if you had enough withheld, the amount of your refund. This basically works the same way with your pension. In your retirement packet, there will be a tax withholding form where you tell us how much you want withheld for Nebraska and federal income tax from your monthly pension check. You can change that withholding at any time, and we automatically withhold at that rate from every check. Now, if you move to another state, you will need to contact that Department of Revenue of that state because we cannot withhold state taxes for another state. So if you move to another state, you'll need to contact them and let them know I have a pension benefit that is taxable and I'm a resident of your state now, and you'll have to work out how you're going to make those payments with them. And then you'll also need to contact NPERS to let us know that you are not a Nebraska resident and instruct us to stop withholding Nebraska state income taxes from your retirement. Then at the end of the year, Nebraska will send you a 1099-R. This is the form similar to a W-2 that you will use to calculate the amount of your taxes, and then you'll see, will I get a refund this year because I had enough withheld, or will I have to make a payment in because I did not have enough withheld? Now, some of you on your statements that you get may notice that excuse me, we break out separately the money that you've contributed prior to 1986. Why are we doing that? Well, because the money that you contributed to the plan prior to 1886, you have paid your income tax on. That means while most of your benefit is taxable, those pre-86 contributions have to come back to you tax-free. If you're receiving a monthly lifetime pension benefit, we have to break out those contributions over time. In other words, let's say you've got $5,000 that you contributed to the plan prior to 1986, that has to come back to you tax-free. We can't just give you that $5,000 up front at the start of your benefit. Instead, we have to break out that dollar amount over your lifetime benefit. And the IRS has a chart, which you can see here, which tells us how many months, or what is your lifetime, that we must utilize when breaking out that already taxed money. So let's say if you started your benefit at age 55, 360 months then is your lifetime. So we would have to take the amount of pre-86 that has to come back to you tax-free. We divide that by 360, and then that is the amount you would receive tax-free in your first 360 payments. Now let's talk about suspension of benefits and reemployment. During retirement, it's extremely important that you keep your address updated with our office. If we send you paperwork or information through the mail and it comes back as undeliverable, the retirement office will make an effort to track you down. But if we are unable to find you, we will suspend your benefits until you do contact us and provide an update to your address. So this is very easy to avoid. Just keep your address updated with the retirement office and you will not have a suspension of benefits. The next thing I want to talk about is reemployment after retirement. As I mentioned before, the federal tax code does require you to terminate employment at all participating employers in the plan prior to begin receiving your retirement benefit. The Nebraska statute must keep your plan in compliance with this federal tax code retirement, so the Nebraska statute says you must incur a bona fide termination, and you must also incur a minimum 180 calendar day break from your last day of work if you intend to begin receiving your benefit. During that first 180 calendar days, you must not provide service at any participating employer. And we talk about service during this time, we're talking about paid or voluntary service that includes part-time, temporary, or seasonal service during the 180 days. Your plan does have one provision to allow you to provide limited substitute service during the first 180 days. However, you need to be careful that you're not providing too much service to run afoul of the federal regulations. Subbing is allowed during that first 180 days, provided you are filling in for a regular employee. That's important. That's part of the reason why we can allow this, is because this isn't your job that you're performing that day. You are filling in for another individual who is supposed to be there to provide that service. But you should not be providing substitute service during that first 180 days on a regular basis. Now, regular basis, that's difficult to provide a definition for. Unfortunately, the federal tax code does not give us a hard and fast rule on this. When we look at what is or is not on a regular basis, some of the things that we're going to look at as qualifiers are that subbing is done on an intermittent basis. It's sporadic, random, and discontinuous. That helps us to determine that you are not running afoul of the regular basis criteria. I'd like to give you an example now and point out what may or may not be considered acceptable subbing service during this first 180 days. Let's begin with this example. If the school calls you up during the first 180 days and they would like you to sub one time, well, that definitely is not on a regular basis, and that would be considered okay under the federal tax code regulations and under Nebraska statutes. But what if the school were to call you up and they'd like you to sub for, let's say, 3 months for an employee who's going to be out for an extended time frame? Clearly, that is going to be on a regular basis and would run afoul of these federal regulations. But let's take it one step further. What if they contact you and would like you to sub during the first 180 days for 3 months, but the individual you're subbing for only works on Friday? So the school is asking you to come in every Friday for 3 months. Well, again, that would be considered on a regular basis for two reasons. One, because it is happening every Friday, but also you're providing substitute service every single week during that 180 days. So both of these situations would be very problematic, and you should not be doing that during the first 180 days. What if the school would like you to come in and volunteer for service? Well, again, it doesn't matter if this is paid or unpaid service. It's all counted the same. So volunteering during that time frame will not provide an exception to these regulations. Another issue that we need to look at that runs even beyond the 180 days is you cannot have a prearranged return to work with your employer if you want to terminate and begin drawing your benefit. And that includes any written or verbal agreement made prior to or during your 180-day break. So you cannot agree in advance with your employer that you're going to return to service with them even after you've accrued the 180 days. This includes agreements to provide paid or voluntary service, and it includes part-time, temporary, seasonal, and coaching agreements. If there is no bona fide termination, then we've got a problem, because now you are running afoul of the federal tax code, and that's a problem for the plan member. It's also a problem for the plan, because now the plan is not in compliance with the federal tax code. So if it is determined at any point in time that there has not been a bona fide termination of service, you must repay all benefits that have been issued to you during that time frame that you were receiving the benefit, and that could include interest. And if you do not have those dollars on hand to make that repayment, you could be looking at potential garnishment of your assets, including other retirement accounts. So this is very important that people are careful with this, especially with the prearranged returns to work. Because if an individual, if it's discovered that there was a prearranged return to work, they may have been drawing their benefit for several years before this comes to anybody's attention. If that happens, we could have an individual who maybe have drawn hundreds of thousands of dollars of retirement benefits before this comes to light. That individual, if it was determined there was a prearranged return to work, would be required to repay all of those dollars. So this is something, again, people need to be very, very careful about. We don't want people jeopardizing their retirement by entering into these prearranged returns to work or not incurring a bona fide termination of service when they begin their benefit. Now, we do have scenarios where people are reemployed at a participating employer after they have incurred a bona fide break in service. If that does happen, they will return as a new member. They will continue receiving the benefit that they had accrued under their prior employment, and they will start contributing to new account under the tier in effect at that time. So if this were to happen now, they would return and start contributing and create a new tier 4 account. Now, we know that some people may not be aware of these termination requirements. We don't want these individuals to get in trouble. We don't want the plan to run afoul of these regulations. So a couple years ago, we started using termination forms. Both the member and the employer are now required by state law to complete these forms, and these must be received by NPERS before we can begin releasing retirement benefits to you. The form does require you and the employer to both report any early retirement incentives that may have been paid to you and any prearranged returns to employment that may be in place. Let's talk now about how to apply for your benefit. We're going to begin with the timeline on applying for your benefit. One thing I want to point out again, it is your responsibility to apply and complete your application for retirement and get that back to our office before we can establish an effective date of retirement for you. And there are some school plan members that think that this plan works similar to Social Security, and they think that if I wait until I'm 70, then my benefit will increase up to that age, and that is not true. In your plan, once you terminate employment and you've reached the moment where you're eligible for a full unreduced benefit, you need to be contacting our office and applying for that benefit. Otherwise, you're simply missing out on benefit payments. And what is the timeline that we recommend? Well, you can contact our office to begin this process up to 6, but preferably no less than 1 month prior to your effective date of retirement. Why 6 months? Well, because the first step in the process is we're going to go through your work history. We call that verifying your salary and your service credit. And if you've worked at multiple employers or you've got years where you worked partial years, sometimes this can take a bit of time to get this accomplished. Now, once our staff has verified your salary and service history, then when you get closer to your effective date of retirement, we will use that data to calculate an estimate of benefits for you. That estimate of benefits is based on your work and service history at that time. Then that estimate of benefits is bundled together with your retirement packet. Your retirement packet then contains the application for retirement that you need to complete and return to our office to establish and apply for your benefits or your effective date of retirement. Other pieces of paperwork that you will see in your packet are the tax withholding form that we talked about earlier, that you need to designate how much you want withheld for Nebraska and federal income tax from your monthly pension. There will also be a direct deposit form where you tell us where you want your pension benefits placed. For the member, you will have to provide us with proof of age. So most people will provide us with their birth certificate. And then we also again need that termination form we just talked about earlier. Now, depending on which option you picked, we may need other pieces of data from you. Like for instance, if you pick the spousal, the joint survivor option we talked about earlier, then we do need proof of marriage, and then we'll also need proof of that dependent's age. So we'll need your spouse's date of birth if you pick the spousal option. If you pick the non-spousal joint survivor, then we'll need the proof of age of that dependent you have selected for your beneficiary. As you go through this process, you may have questions, and we want to encourage individuals that during this time we have had to cut back again on our seminars and our office visits, but we want you to feel comfortable in contacting our office at any time if you have questions about your benefit, the application process, or completing your retirement application. Thank you for your time.